ICT's Power of 3 concept, encompassing accumulation, manipulation, and distribution. Initially, we'll cover the basics of open high-low close and open low-high close before delving into the essence of the Power of 3, including its identification and illustrative examples. Open high-low close and open low-high close. Prior to starting, it's crucial to understand the importance of analyzing higher time frame order flow or liquidity trends. Without a coherent narrative, one might end up merely trading patterns. What exactly are open high-low close and open low-high close? These terms signify the opening, lowest, highest, and closing points of a candle in a higher time frame chart. For example, in a daily candle, this might manifest as the price opening, hitting a low, reaching a high, and eventually closing. The objective here is to capitalize on the major movement or the substantial portion of the intraday range. This is where the concept of AMD, or accumulation, manipulation, and distribution, plays a vital role. In this context, accumulation refers to a period of range-bound or consolidated trading. This phase sets up buy stops above previous highs and sell stops below previous lows. The manipulation phase is characterized by a false breakout from this range, trapping long positions initiated during accumulation and enticing breakout sellers into the market. Subsequently, the price moves upwards, completing the Power of 3 cycle. This cycle is evident when accumulation leads to manipulation, which then triggers breakout buyers and squeezes short positions, followed by a downward distribution. Entries. Regarding entry strategies using the Power of 3, I typically adopt one of two approaches. The first involves seeking reversal patterns during the manipulation phase to capture the entire distribution phase. Alternatively, if I miss this opportunity or prefer not to trade in this manner, I look for continuation patterns within the distribution phase. Revisiting our example, for long positions, one might consider a reversal during the manipulation phase or a continuation pattern for an upward move. Conversely, for short positions, one could look for a reversal in the manipulation phase or a downward continuation. Let's explore some real chart examples to demonstrate these concepts. Example 1. On the charts, it's important to recognize the fractal nature of this concept, as it applies to both lower and higher time frames. We'll begin with lower time frame examples before progressing to higher time frames and intraday profiles. Take, for instance, where the price initially rises and then falls sharply. By marking the low of the morning, we can observe what transpires when the price breaches this level. This leads to the formation of a consolidation range. To potentially anticipate a downward continuation, one would look for manipulation to the downside of this range. Conversely, for an upward reversal, manipulation to the downside followed by an upward distribution is expected. Let's examine what unfolds next. An aggressive downward move outside of the range, sweeping the low, then sharply re-entering the range, indicates a manipulation phase. This sets the stage for a potential long entry, not necessarily reliant on a shift in market structure, as breaking the previous high is not a prerequisite. Possible strategies here include looking for an inversion or utilizing a box setup, based on the previous body's low. The goal would be aiming for a 2-hour return. Upon achieving accumulation and manipulation, we can clear the chart to better visualize the ensuing distribution phase. This represents the completion of the Power of 3 cycle: accumulation, manipulation, and distribution. Example 2. Let's analyze the current price action. Notice the failure swings at this high point and the sell-side liquidity positioned there. Observing the subsequent price movement, we encounter a consolidation phase, followed by a forceful exit from the range, sweeping the low, and then a strong re-entry into the range. This sequence signifies accumulation, followed by manipulation that not only breaches the consolidation lows, but also targets sell-side liquidity. The next expectation is a distribution phase or an upward move towards the failure swings. For entry points, an inversion at this juncture offers a potential setup, with the stop placed at the low and the target at the high. The pattern ultimately results in a distribution phase that surpasses the previous highs.